Welcome to GRE. I'm your host, Keith Weinhold. As we talk to a GRE listener like you today, he didn't learn about this show and its real estate strategies until later in life, and some people do, so he doesn't have as much time to recover from financial mistakes. Let's see what happens today on Get Rich Education.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Elmira, New York to Elmhurst, Illinois, and across 188 nations worldwide. You're listening to one of America's longest running and most listened to shows on real estate investing. This is Get Rich Education. I'm your host, Keith Weinhold. Before we bring in this week's guest, mortgage rates have ticked a little higher, such that they're now over 7%. Still historically average, but yet it's the highest they've been in a while. So how do you adjust to that as an investor? In fact, for new deals that you're looking at, these higher rates compress your cash flows so that it's more likely that your projected monthly rent income is lower than your mortgage and operating expenses. That's negative cash flow. Well, as you're probably an adherent to the abundance mindset and real estate pays five ways, you might still agree that it is hard to find a better place to put a dollar today. Well, in that case, one way to approach new purchases is, say, rather than make a 20% down payment, make a 30% down payment, and now you're cash flowing again. In that case, I think it's important to acknowledge then that, in general, the deals are not as good as they were a few years ago. They were just really good back in 2018, 2019, before the wave of inflation hit in more recent years. So say if you put 33% down rather than 20% down, now you're only getting 3-to-1 leverage, not 5-to-1 leverage. If you do think it's still the best place for you to put a dollar today, and you sure can make that case with the certain long-term housing shortage now and ahead, if you do put a greater percent down, sometimes what'll happen is that your lender will give you a lower interest rate for doing that, because the bank is taking less risk when you're putting more skin in the game. Then down the road, in a few years, or whenever it is, in the event that interest rates fall, if you can refinance, then you can pull more cash out at the same time that you get a lower rate. Note that there are some maybes in that scenario. So those are some of the trade-offs to consider in this higher mortgage rate environment. Run the numbers on making a larger down payment. Now, as we're about to speak with this week's listener guest, say that if you're not in your 20s or 30s anymore and you're age 50 plus, in that case, it's more important for you to be a sound investor, and that's because you have less time to recover from your financial mistakes. Today's guest also has got to get it right because he has a family to support. He is age 56 now, and he didn't start listening to GRE until he was in his 50s, and that made him course correct. This guy is a winner. In the past, he's appeared as a cover model on fitness magazines for his ripped abdominals. Today, he runs a platform for a home gym system that he invented. Maybe I'll ask him about that once we discuss the real estate. Now, he actually had multiple real estate investing careers. Before 2008, he did things in a way that I'll call the old-fashioned way, and that is he bought property in his local area, which is Los Angeles, and it was higher priced, and that way he could look after it and manage it himself. Well, that failed. See, in higher-priced coastal markets, your margins are so thin that you feel like you might have to self-manage in order to save yourself the management fee. And even after all that, you might still be cash flow negative. I mean, gosh, if you self-manage cash flow negative property, that is draining both your time and your finances every month, although the appreciation could still work for the long term if you've got leverage there. But instead of all that, when you're in an investor advantage market, Your margins are better such that you'll be more profitable each month, even if you pay for professional management. Once he started listening to GRE, he came back from local investing and is now successful in real estate with our approach, investing across state lines. Let's meet him. You know, some of you GRE listeners really are remarkable people, and I get to talk to one of you today. Today's listener guest says that GRE was the catalyst for his investing. He began turnkey investing just a few years ago at age 52. He's 56 now. And gosh, I hope I can look as good as him when I'm 56. With his master's degree, he has 30 plus years as a licensed physical therapist. He trained at the Mayo Clinic. Interestingly, he invented and patented a fitness system in 2008 called the Anchor Gym that I'd like to ask him about at the end of our chat. He's a military veteran. He's a cancer survivor. He has his own family, and for our chat here, he is a turnkey real estate investor, but he didn't start until 2019. He now owns 11 cash flow and rental properties. Hey, it's going to be great to hear about your financial life turnaround. Welcome to GRE, Shawn Finnegan.
Hey, Keith. Wino, thank you so much. Appreciate it.
Well, Shawn, we talked a little off air, and you talked about how at age 52, you sort of went from fearing your financial future because you were saving your way to retirement conventionally to taking charge with the help of GRE's guidance, as you put it. Don't quit your daydream is a mantra that resonated with you. So go ahead and tell us about it.
Well, at age 52, I went through several downturns. The 2008 downturn really affected me, like many other people. And then a divorce, like many other people, affects you as well financially. So I had two major blows. And then the cancer hit at the same time I got a divorce. Yeah. So there's a lot of things that kind of imploded. And then that made me think, oh, I need to save my way harder to retirement. And then in that thinking, I started doing numbers and I'm like, it's just not going to happen. It just won't work. So that got me to looking on the internet, and then you popped up and Don't Quit Your Daydream and all these things that resonate with me, and the 5 ways to get paid with real estate and things like that. So I just said, you know what? I like this guy's way he does business and how he communicates. So I resonated with your message and you just started to take action. At 52, I have 11 rental properties and going to buy a fourplex here shortly with my VA loan.
Great. Yes, you would have those Veterans Administration benefits with your service. And thanks so much for your service. I do want to get into the architecture of how you built this portfolio from your shifted mindset shortly. But I know you like to say that you kind of used arbitrage, a concept that I talk about a lot, to accelerate your dream. And just about 10 months ago, you moved from the LA area to Costa Rica.
That was the ultimate arbitrage move for sure, from LA to Costa Rica, because there's a lot of discounts here. Rents are really inexpensive and you get a lot more for your money. Everything's pretty much inexpensive here. So I'm fortunate enough to have a family that wanted to move to Costa Rica. It's obviously a little bit of a shift from LA to here, small town, but the kids love it. I love it. It's more simple and it's easier to manage my finances and move my game plan along that much faster, actually.
Well, I'm so glad that you've got this life momentum. I mean, what a comeback, overcoming that awful confluence of circumstances that happened to you in 2008. And then some years later, you're 52. You know what they say about conventional investing and 401k investing? Oftentimes they say something like, oh, if you don't get started until age 52, like with compound interest, that's too late. You're never going to get caught up. So you talked about how you felt financially behind in getting ready for your future, call it retirement, however you want to define that these days, whatever it is. But you found a vehicle where you can catch up, even if you start later.
It wasn't even about catching up. It was about shifting my focus from saving this big pile of money that will spit off cash later to just cash flow. And then your concept of, getting turnkeys, I got more laser focus on that. And that just opened up so much more for me as far as this lifestyle. I mean, now in Costa Rica, I make about $2,000 a month cash flow on these 11 properties. So that goes a long way down here. So I'm able to live a nice life.
Yeah, that's a great way to put it. I mean, that might be a part-time sort of income, although a nice stream of relatively passive cash flow if you continue to live in the United States. Some people might see it as a surrogate for a part-time job rather than taking on a part-time job with your limited resource of time. But okay, you found a way to use that and get, I guess we'll call it better arbitrage from $2,000 of monthly cash flow through 11 rentals there in Costa Rica. Let's back up and talk about how this was funded, because I knew one of the things perhaps launched from a GRE epiphany was you stopped making 401k contributions.
Yeah, pretty much overnight. That was a major shift for me, but I had to do it. So the EQRP recommendation, that really worked out for me because you can take one, it's a form of, self-directed funds. So I was able to buy a property with the funds and I was also able to borrow against it. So I did a couple different things with my money that I would never have been able to do with the 401k, structure that's in there in Wall Street. That suggestion right there made a world of difference. I got 2 properties out of that. Thank you for that.
Yeah, if you want unconventional results, you sure do need to use unconventional techniques in order to get there. So now, did it take any sort of 401k withdrawal for you? Did that occur at all?
No, you keep it in there. Yeah. So what I did was I bought one property with cash from my EQRP, and then I bought another one on a loan. So you can loan up to a certain amount. So it was up to $50,000 in my case. So I was able to put that towards another property. So I literally got 2 properties out of that. And I still have some obviously left over, and they're working, generating interest for me with real estate notes.
Excellent. More income streams. Did you have an employer-sponsored plan when you lived in the United States, or have you strictly been an entrepreneur for a while?
Off and on entrepreneur, but the last 4 years leading up to my 52nd birthday, I was a W-2 earner. But before that, I was kind of like an entrepreneur doing fitness and physical therapy, contracting and things like that. But I was a saver, so I would do the retirement, IRAs and Roth IRAs and traditional IRAs. So I had that. So I shifted that all into the EQRP, which made a lot more sense for me, that I had more control over it. I could do a lot more with it to move my life forward and how I wanted to use my money.
What gave you the confidence to do something unconventional? Because even a lot of 25-year-olds and 35-year-olds think that, well, I don't want to invest in something that I think feels safe, like investing in mutual funds, whether that's through a 401k or 403b or IRA or just on their own account. So many people want to go that way. I think because they've never learned anything differently. And I think because most everyday employees, they're also surrounded by other employees doing the same thing. So it just feels like you're a fish with all the other fish swimming in water, just like everyone else. And you've kind of got to use some sort of inertia to go ahead and get out of that fishbowl. So can you tell us more about really what gave you that confidence to do things that are unconventional and are going to create things like leverage and arbitrage and cash flow when you're actually young enough to enjoy it, which are all foreign concepts when you're in that 401k type of fishbowl with mutual funds?
Well, what gave me the confidence was 3 words: get rich, education. And I mean that. So I would do the podcast, I would binge, and I would walk, and I would binge, I would listen to it, and it made a lot of sense. So once you know it makes a lot of sense to you and you research it yourself, it's easier to take action. People ask me that all the time, like, how'd you do it? And I said, well, I just learned from the people that are doing it. And that's what gave me the confidence, and I trusted your advice.
Yeah, and part of that advice is I really think when it comes to that mutual fund world, those conventional investments, a lot of people just aren't thinking about the 5 drags on that long-term, call it 8 or 10% rate of return of inflation, emotion, taxes, fees, and volatility. When you subtract all that out, you don't have a lot left. You're really not even thinking about using other people's money unless you have like a 1-to-1 match from your employer. You talked about getting a loan on properties. Now you're leveraging other people's money, not just getting the returns from your own.
Exactly. I did it early enough so that I was able to do a equity harvest on 5 of my properties. So I was able to pull out almost 100,000, and I was able to buy 3 more. So I wanted to buy 10 properties before I moved to Costa Rica, and that happened. And I bought the one cash. That's the outlier, but so I have 11. But I mean, to get my 10 conventionals before I moved.
All right, now that's very much congruent with the financially free beats debt-free mantra here at GRE. Equity accumulated, you pulled it out, taking on more debt. However, your tenants reliably make all those debt payments for you, and then transferring it over here, we can leverage even more property. I mean, if you have a property that runs up to 50% equity, and you very well might have, Shawn, because you began your buying around 2019, we've had a huge price run up since then. If you got one property with 50% equity, you just have 2-to-1 leverage in it. But if you're able to pull cash out of there and buy 1 or 2 more properties with it, now you've got like 3 properties at 4-to-1 or 5-to-1 leverage instead of just one property at 2-to-1 leverage. And this is an example of how compound leverage trumps compound interest.
I'm totally in on that concept of buy as many as you can, as fast as you can, let them mature. And then when they're ripe, then take it out and just keep repeating that process so you can build a nice, healthy portfolio and your cash flow exponentially gets higher. Also, just with time, my rents have gone way up too. I mean, over time. So that's a natural increase or uptick in my cash flow over the years for sure.
Now, of course, you did start buying in 2019. Prices were lower then. Interest rates were lower then. It's a more challenging environment today with those higher interest rates. What are your thoughts around that? Do you think it would be less advantageous for you to go ahead and make those cash out refinance moves now, or would it still be better to do that than not, depending on one's situation today, Shawn? What are your thoughts there?
The best time to do it is when you have the resources to do it. It's a different climate right now. I know there's points relinquished by sellers right now, so they're trying to move properties a little bit more unnoticed. But as long as you buy within your scope of possibility. So like I always bought my properties and my highest one was 130K. My lowest one was about 90K. So I have everything in between. And so what I would do, my mindset was, okay, I'd call my mortgage guy and I would say, okay, I want to buy a property. How much do you think I should save? How much do I think I need in reserves to qualify? And he would say, well, you can probably get about 130 grand based on all your information here, your job, your cash reserves, and you have to save X amount of money to do that. So that's when I have the target. So I get the target of, okay, I have to save this much, and then I start saving. And as soon as I hit like the 25,000 or 30,000 number, that's when I take action. And I just start the process of the turnkey purchase.
So beginning to understand the importance of cash flow, some people at age 30 have that epiphany and they're like, oh, this is great. Now I'm actually going to have income that's going to benefit me for decades. Even though you began later, age 52, you still found it worthwhile to get that benefit, even though it might be for 2 decades less than a 30-year-old.
Yeah, it's never too late. I mean, honestly, as long as you stay focused and you don't get distracted by the noise, and that's what I like about your message. It's repetitive enough that you don't want to hear anything else, because there's a lot of shiny objects out there in the finance world that you could chase. But for this one, for me, I just got laser focused in what I was trying to do, and I would just rinse and repeat. Honestly, it's just you do one, you get on base, so to speak, and then the next one becomes easier. I was closing 3 at one time, and it was just the same as closing 1. You're just signing them a lot more reduction. It takes a little bit longer, but it's the same effect. And then the banking system's all set up and automated. And it's very, very passive from then on out. It's active, to get it and go through all the qualifications and things like that. But once you get that, you're theirs. I can't wait to get my next property. I just have to kind of hold off until I get to that point where I'm ready.
Lending requirements are still pretty stringent. So yes, you still do have to come up with a lot of paperwork for those first-hand Fannie or Freddie loans. There's no doubt about it. In fact, much like you, Shawn, I buy single-family homes 2 at the same time and try to keep those 2 through with the same lender all the way through, trying to get the same closing date if I possibly can. Because yeah, it is a bit of a hurdle to overcome, especially if you haven't done it yet, to get that first one. It's really that first one in a lot of senses, I think, is the most important one to get that ball rolling. Is that what you found?
Yeah, I found that too. But I have bought properties before, but I was doing house hacking. So when I got married, we bought a condo, and then we moved out, we rented that and bought a townhouse, moved out and rented that. But when the 2008 market crashed, I didn't buy for cash flow. That was the problem. So I look back and analyze, what I did wrong there. And that's basically what I did wrong. So it was just too hard to keep those guys afloat. So I went through 2 foreclosures, and that took a while, kind of affected me, as far as looking at real estate again as a means to get out of my financial situation. I had to really take a deep dive into my psyche, whether or not I want to do it, because a lot of my family members are like, don't do it again because you're going to get caught, blah, blah, blah. So again, I just kind of reverted back to a different strategy with real estate and not buying in a market that didn't make sense, like Los Angeles, where I was at. And so just focusing on the turnkey markets that the numbers are good. Like you say, live where you want and buy where it makes sense. That's one of your mantras. So I just focused on the Mid-South area.
Okay, that's your preferred geography, and you were back doing house hacking since before they called it house hacking. You're a really resilient person to have bounced back from that foreclosure experience. And then, apparently listening to me gave you such a new angle on real estate investing that it sounds like maybe that gave you the courage to start again with a different strategy, which is typically a non-local strategy.
Yeah, I had to overcome a lot of mental hurdles, because I was scarred. So I had to let all that stuff go and go, this makes a lot of sense. As I started to research it, as soon as I understood it, I was able to move that much faster, that much more confidence. And I knew that the accessibility of your company and things like that were there, and all the information was readily available via podcasts, YouTube, etc. Definitely had to overcome some emotional scars with that, because I was a landlord too. It was like double whammy, dealing with tenants that didn't pay and stuff like that. And that resonated with me too. Like, oh, I don't have to manage my own properties. Oh, hallelujah. Because that's just, like you say, you have to do it to see how it feels. Yeah. But then after that, you don't have to do it. And that's exactly what I did. And it feels so much better.
Oh, when I started out, I managed my own properties, and I believed all these myths about property managers. And Shawn, it was about 5 years after I was investing in real estate, 6 years, that I learned about property managers. And I learned from my friend, oh, Keith, a property manager, they do absolutely everything for you. They collect the rent, they manage all the tenant relations, they facilitate all the repairs. The tenants don't even know how to get a hold of you, the owner. I was like, wow, that was actually one of the better days of my year that year when I had that epiphany and started with a manager. And so many people think about an overflowing toilet at 2 a.m. that you need to get texted about. And that's really not real estate investing at all. That's landlording. And we sub that out to property managers, professionals that do it. We're talking to a remarkable GRE listener guest. As we learn more, we find out just how resilient he is. I think the conventional wisdom is something like, hey, you better start investing in your conventional retirement plan while you're young and make sacrifices and give up 10 to 15% or more of your income during some of your best years. And the reason that you have to do that is because with those conventional retirement plans, all you got is buy low, sell high, compound interest and tax deferral. It's all pretty impotent compared to real estate investing. You're listening to Get Rich Education. We're going to talk more with GRE listener guest Shawn Finnegan when we come back. I'm your host, Keith Weinhold. GRE listeners can't stop talking about their service from Ridge Lending Group, NMLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to fourplexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com. I'll just tell you, for the most passive part of my real estate investing, personally, I put my own dollars with Freedom Family Investments because their funds pay me a stream of regular cash flow, and returns are better than a bank savings account, up to 12%. Their minimums are as low as $25K. You don't even need to be accredited for some of them. It's all backed by real estate, and I kind of love how the tax benefit of doing this can offset capital gains and your W-2 job's income. And they've always given me exactly their stated return, paid on time. So it's steady income, no surprises while I'm sleeping or just doing the things I love. For a little insider tip, I've invested in their Power Fund. To get going on that, text family to 66866. Oh, and this isn't a solicitation. If you want to invest where I do, just go ahead and text family to 66866.
This is Ridge Lending Group's president, Shaylee Ridge. Listen to Get Rich Education with Keith Weinhold. And remember, don't quit your daydream.
Welcome back to Get Rich Education. We're talking with a GRE listener guest, and I really like shows like this because oftentimes the podcast is largely a one-sided conversation, even a monologue at times. In days like this, or when I get to have a dialogue with you, the listener. We're talking with Shawn Finnegan, who now lives in Costa Rica with his family by way of Los Angeles. A longtime GRE listener that's listened to every podcast episode, it sounds like. And really, I think part of that, Shawn, is I know that you were telling me before we began the interview today that GRE really made you be able to rewire your conditioned thinking or mindset about money. Tell us more about that.
By listening to probably all of them, honestly. I mean, I started from one. I said, okay, I've got to know what this guy knows. And then you brought so many great guests on there to back everything up. You know, that's what another tool that was critical is that, you know, you backed everything up with really sound advice, and also the guests you have on there. It's amazing.
Yeah, I appreciate hearing that. I have heard other people tell me that. I have basically posited my mantras and how that makes a lot of sense and how you want to diverge from the herd. And other people have told me that, oh, it wasn't until you had some of the best known names in the industry, Keith, that I really got behind you. And when they corroborated what you were saying, that's what really changed my mindset.
Yeah, the 401k originator, I can't remember his name.
Ed Bennett.
Yeah. That really got me thinking. And, you know, I tried to relay this to people that I was talking to. Like, I don't believe in 401ks anymore. And here's why. Listen to this podcast. I was having the podcast. But even then, some of them just had a lot of problems with it, you know, and they look at Wall Street for what it is. And it's just like a casino. You're betting in one way. And then all of the fees are not disclosed. I talk to people a lot about that. I say, yeah, I'm making this percentage, but I say, well, what's their fee? Oh, I don't know. Well, you better ask them because that's coming out. And what's your tax liability? Oh, I don't know. Well, you better find that out because it could wipe everything out. So if people are like, oh, I'm going to make a lot in the stock market and then play the stocks. I'm like, yeah, well, good luck. It's like catching a falling knife, right?
Some people don't even seem to understand that with 401ks, when you're in what's called the required minimum distribution period between age 59 and a half and 72, you must begin paying taxes on it at that time as well. A lot of people don't get it.
Keith, I study a lot of meditation. And one of the ways to meditate and become aware of your awareness is to state a mantra. And your mantra really stuck with me. And that helped me move my game plan forward that much more, which is don't quit your daydream. And so I kept thinking about what is my daydream? What would that look like? So I got to visualize. So that got me thinking about answer that question in a realistic kind of way. Here I am in Costa Rica living the dream. So to your listeners, I would say, you know, don't give up your daydream. You know what I'm saying? So that's the mantra. Don't quit your daydream. Keep that in mind and also define that. What does your life look like when you achieved what you need to achieve with finances or otherwise? For that matter, I mean, success is what you interpret it to be. So you have to sort of look at it and answer the question, when will that happen? When will I be successful? It's right now.
Life is meant to be lived, not postponed. And we're talking about improving one's life through financial betterment because effectively one can buy time. And that's really important when one understands that their very life is made up of chapters of time. So that's really what we're talking about here and why it's probably something that you don't want to postpone until age 59 and a half or however you think about it. And I think one thing that it comes back to, Shawn, is there's a rampant belief that money is a scarce resource. And therefore, to a lot of people, financial betterment comes down to how can they shrink their expenses rather than how can they grow their income, right? Don't live below your means, grow your means. You're living below your means because you think that money is a scarce resource. You're just going to reduce your quality of life and you can never get that time back. Now, there's a little something to be said for delayed gratification, but in the long run, too much delayed gratification is denied gratification, and you decided that it's time to put an end to that.
Yeah, it's an interesting lifestyle now. I can do what I want to do when I want to do it. For example, I just got back from Greece with my mother. We did a hiking trip for like 15 days. And it was just amazing. And if I had a job, a workaday job, it would be much more difficult, if not impossible, to do that when I was working in a hospital. So, I mean, this affords me all this flexibility to live a life untethered, so to speak.
Yeah, we're talking about some terrific outcomes here that you had. And really that came through a conduit or these vessels that we call properties. You talked about how you've added 11 rental single-family homes in 4 years. You mentioned earlier in the Mid-South area. Do you want to tell us more about markets and how you chose the markets that you did select?
Well, I chose Memphis, Tennessee, because it's always ranked the top, as far as investor money. I just went there, and my idea was to work with one good provider that I could trust. And I had to research that, and I found the one I thought was really, really good. So I still have them today. There's markets up and down with real estate. Obviously, it's not totally smooth sailing. You have some issues, but overall, it's been a great ride. And I want to keep investing there because the economic drivers are still really strong there. I think that's a really good market. And I've thought about moving to another market, but I just feel this is good for me. So keep it simple.
Interesting. So you're concentrating it all there. I talk about the benefits of investing in more than one market, but if you're only going to be in one and you're interested in the production of cash flow, that's not a bad one to choose there in Memphis with their durable rent incomes from that distribution-based economy.
Absolutely. Yeah. No, I'm going to consider outside. My mother lives in Sarasota, Florida. So there's possibility I could buy a duplex down there. So I might exercise my VA loan down there, and that could work. So we'll see. I'll let you know.
Depending on the asset, that sounds like it could be more of an appreciation play, although you might get a little cash flow off that one as well. But that area sure has appreciated more than the Memphis area has here in recent years. That's great. I want to ask you about your invention shortly, the Anchor Gym. But before I do you just have any last overall thoughts about this whole mindset shift and then how you've acted on it?
I would just tell your listeners just to start at podcast number 1 and take a walk every day like I did and just listen to one and then every day do it. So you get some exercise and you start to think, you start to absorb the material, and then it's easier to take action when you understand what you're doing. That's the mindset shift that a lot of people are scared or they don't know how to do it. The Get Rich Education community has everything set up for you. So you can listen and learn and engage and look at turnkey markets that make sense and look at the economic drivers in each of those markets to determine where you want to plant your flag. Once you do one, it's easy sailing after that. Just rinse and repeat.
Yeah, Get Rich Education really has 3 main ways that people consume us. Number 1 is the audio podcast that you're listening to right now. Number 2 is our YouTube channel. And then thirdly is our Don't Quit Your Daydream email letter. But yeah, it seems like the podcast, this show right here, is the one that resonates with the most people. And yeah, Shawn, it was episodes 1 through 6. They were all monologues, just me talking, laying out this completely new, abundant way of thinking and acting. It wasn't until episode 7 that I had any guests on. So that's really where you get the mindset foundation. But I still think I tend to weave in more mindset than the average investing show does here over time. It's funny, if you go back and listen to those first 6 episodes where I lay the groundwork, you might like the content, but I'm talking so slowly and carefully. You can tell that I'm not very used to talking on a microphone. That was back there in 2014. So your long-term listenership is really so appreciated. That really means a lot to me, Shawn. Tell us about your invention. It's called the Anchor Gym, and I think this is something I can really appreciate. I already looked at your website. Now, I use things like barbells and dumbbells for bodybuilding, although by looking at me, you sure could believe I don't do any bodybuilding, but I actually do some of that. However, the exercises that I like more are devices that allow for a more dynamic range of motion, like TRX and BOSU. Is that what the Anchor Gym allows you to do, Shawn?
In a sense, it allows you to use bands and straps in a unique way. And you can use them on your wall, on your door, on a bar. So we have a lot of ways to engage. But bands are one of the most used fitness products in the world because they're portable, they're inexpensive, they're durable. A lot of people gravitate towards those, and they don't cause any damage to your floor, and et cetera. So as a physical therapist and personal trainer, I kind of wore 2 hats at the same time for many years. I was in a clinic, and I was trying to figure out a way to anchor all my stuff in one system, and I couldn't find it. The other systems just didn't have it. You had to buy their specific bands and their big piece of equipment and things like that. So I basically said, I'm going to make a better mousetrap. So I invented a modular system, inexpensive, and anchors all bands and straps without any sort of clip hooks or fasteners, all these things that are cumbersome and annoying because you lose them. So any band on the market will attach to our stuff, although we have our own brand now, the Anchor Gym branded bands, and our body weight strap looks like the TRX, the same concept. We have, basically cornered the wall fitness market, in a sense. I mean, there's a lot of copycats out there now, but COVID really drove our sales a lot because of the gym closures and home fitness.
Right.
So we have a larger footprint, and we're definitely expanding. We're in Canada, we're in the UK and Australia now. We're expanding into other different markets and countries. Simplicity is the key, right? So I just couldn't believe it wasn't out there already. I started looking around and started working with engineers. Like, that's got to be out there. It wasn't. I was able to get a patent on it as well. Of course, there's always still people trying to work around it, but we're the first movers as far as, modular system, universal anchoring platform, basically.
Now, they say that imitation is the most sincere form of flattery there, so that probably tells you something that you were onto the right thing at the right time. That's great to hear. You can check out Shawn's website at theanchorgym.com. I took a look at it, and it's intrigued me. Well, Shawn, I've been impressed with your resilience. You've got quite a story. After all the setbacks, you had the confidence to adopt a new mindset and act on it. It's been great hearing from you. Thanks so much for coming on to the show.
Thanks, Keith.
Yeah, Shawn mentioned our GRE community here. One way that we've expanded community touchpoints with you is with our free coaching that we just added about a year and a half ago. You can get started by selecting your investment coach at GRE Marketplace by just going directly to gremarketplace.com/coach. Now, here on the show, I'm usually trying to explain things in the way that I hope makes the most sense to you. Sometimes I probably fail to do that, like anyone. Sounds like today's guest, Shawn, connects with our message here, and I trust that you do too, since you've listened this far. He did real estate the wrong way with a California condo and townhouse without regard for cash flow pre-2008, and then later, GRE's strategy resonated with him. Learning that real estate is more likely to pay 5 ways when you're not buying in your home market, depending on where you live. I think that was one epiphany there. You probably live where you live for a reason other than where real estate cash flows are best. You probably live there because you grew up there, or you moved there because you were attracted to that area's amenities and resources, or maybe for a particular job. So then, in a lot of cases, it is rather haphazard and illogical to buy income property in your hometown just because you live there. Instead, buy in the best real estate market for you, which is usually across state lines. And yeah, despite that it's just one market so far here in his first 4 years of investing, Memphis has clearly been a great choice for Shawn. There are a few other markets that are just perpetually strong. For example, Indianapolis seems to be one of those other markets that's just so steady with this slow appreciation and high cash flow. Well, hey, if you want to get a look at today's episode cover and super fit looking 56-year-old guest, just go to our URL and episode number today. That is getricheducation.com/464. And you know what else is cool? Shawn is sending me some Anchor Gym components through the mail. And hey, until next week, I'm not the only one that said this on the show today. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.